Wo spielt in den Ökonomien Asiens aktuell die Musik? Sind es die großen Player wie China oder Indien oder sind es doch viel eher die kleineren Tigerstaaten? Ja, und welche Rolle spielt bei all dem Australien? Haben wir oft nicht in unseren Interviews, aber heute schon. Antworten auf diese Fragen jetzt von Sam Conrad. Er ist Co-Fondsmanager des Asian Equity Income bei Jupiter Asset Management. Welcome in Berlin. Let's start with the big picture. You're placing an emphasis on developed Asia and you've excluded China. What are the main reasons?
So we think there's often a misperception that you want to invest in countries just with high levels of GDP growth. There's often not a strong correlation between GDP growth and equity market returns. And China is the perfect example of that. China has had a very strong economic growth period over the last few decades, but its equity market returns have been very, very poor. On the other hand, Australia has had a resilient economy, and its equity market returns have been far superior to those of China. So we think that in investing in Australia, we can minimize unnecessary risks, but actually maximize some of our returns for our investors.
Doesn't this mean you're missing out on opportunities in China?
We really don't think so. We are top-down stock pickers, and we don't like the political system in China. We think that the geopolitical risks between China and most of the large democracies of the world are actually likely to get worse rather than better in the coming years. We think the economic outlook is likely to get worse rather than better because demographics means that Chinese population is already shrinking and the debt levels in various different parts of the Chinese economy are quite concerning. So we really don't believe that we're missing out by not investing in China. And when we look at the abundance of opportunities elsewhere in the region, we actually think it's quite an easy decision. We're really excited by the outlooks for Australia, India, Singapore, Indonesia, the tech companies that we own in Taiwan. So absolutely not. We're happy not investing in China.
So let's summarize. You're not investing in China, but doing heavily so in India. What are the differences between the two economic giants?
Well, they are very, very different. The only real similarity is that they both have more than 1 billion people. But India's population is growing, whilst China's population is shrinking. India has a fully functioning democracy, an independent judiciary, a rule of law, and historically, economic growth in India has translated to positive equity market returns for investors in the Indian market, unlike investors in the Chinese market. India also has multiple very strong sectors that are global leaders. So their IT services industry, for example, is a global leader. Its pharmaceutical industry is a global leader. And this is quite unusual compared to most other emerging markets where your choice of sectors that you can invest in are often dominated by banks or telcos or oil and gas companies, for example. So we think they are extremely different economies and equity markets, and India's is far, far more attractive to invest in than China's.
And please, let's talk about a very interesting topic. Let's talk about Australia. In addition to India, you're also focusing on Australia, which is to some degree economically dependent on China's economic circle. Sam, doesn't this mean you're indirectly introducing new risks?
We really don't think so. So Australia has been the best performing equity market globally since the year 1900. So it has proven itself to be able to perform through different economic cycles. Now, yes, there are certain sectors and companies in Australia that do export to China, but we're quite relaxed about that because the goods and services that China buys in from Australia, they are products and services that China don't have themselves. So they are needing those goods, often commodities, from China. And although we are cautious on the outlook for Chinese economic growth, and we think that economic growth in China will decline in the coming years, we don't think that the demand for those commodities is going to collapse. And so we think that Australia is a very underappreciated market by both global investors, but also Asia-focused investors. And so we're confident that Australia will be able to keep outperforming over time.
Which role do dividends play in all your considerations?
So dividends are very important. We do run the Jupiter Asia Pacific Income Fund. It is an income fund. It currently yields around 4.6%. And through the cycle, dividends make up more than half of all returns from equity markets in Asia. But critically to us, we're not trying to maximize the dividend yield of the fund in year one. So we actually own a very diversified range of companies. We have 30 holdings. Some of them are higher yielding stocks, but all of those companies we think can grow their earnings and dividends over time. But we're also happy to own some companies that yield less than the index, where we see even faster rates of growth. And so that means we're not too exposed to either growth as a style or value as a style. We describe ourselves as looking for companies that are quality income companies, and that means that we hope that we will be able to continue to perform well through the cycle.
Sam, thank you very much for being here. Thank you for your time.
Pleasure. Thank you.